From an early age, culture pushes a highly specific financial milestone. You save your money, secure a mortgage, and buy a primary residence. But the banking industry does not evaluate your ability to build wealth. When you apply for that loan, they calculate the maximum monthly payment you can possibly endure, and they incentivize you to borrow up to that exact limit. That mortgage payment is only the starting line. Property taxes, sudden roof repairs, landscaping, and mandatory maintenance are variable, unavoidable costs that lock up your surplus cash. You are also geographically anchored, unable to pack up and move when a better career opportunity arises. Treating the house as a guaranteed investment is a massive geographical gamble. A house in San Francisco might have yielded incredible returns over the last 3 decades, but today, the market faces severe volatility and population shifts. Compare that to historically distressed cities. 30 years ago, buying property in Detroit was considered an absolute failure. Today, the city is experiencing an economic renaissance, driving localized property values up. Real estate is highly localized and entirely unpredictable. For the vast majority of buyers, a primary residence operates as an expensive lifestyle indulgence, a capital sink masquerading as an asset. Realizing the traditional housing market is increasingly unaffordable, younger generations are looking for alternative methods to acquire capital quickly. This desperation feeds a thriving online ecosystem. Day trading courses and speculative cryptocurrency markets are specifically engineered to capture people who feel locked out of the middle class. These markets operate on the difference between the beer and the foam. A company's operating value, its profits and structural efficiency, is the beer. The foam is the hype, the fear, and the speculation driving daily price swings. Traders gamble entirely on foam. The individuals actually accumulating wealth in this environment are not the retail day traders. They are the online course sellers and the platform operators who collect a fee every time a trade is placed, regardless of whether the market goes up or down. Fleeing the bank's mortgage trap only to buy into a trading guru system does not build financial independence. It simply transfers the liquidation of your capital to a different institutional predator. If you manage to avoid debt and start earning a high income, a new extraction mechanism activates. You enter a social arena where your peers are highly paid, and the pressure to compete with them begins. This environment promotes flex culture. You are pressured to buy luxury cars, designer watches, and large estates, items that rapidly depreciate in value, to signal your success to the people around you. But the signaling is an illusion. When you drive a Ferrari down the street, observers are not admiring you. They are looking at the car and imagining how successful they would look if they were in the driver's seat. Your foundational capital is drained to purchase a completely fabricated social return. The wealth that could have bought your freedom is liquidated into data points of fleeting status. Truly independent individuals take the opposite approach. They ignore the status matrix entirely, live comfortably below their means, and they quietly divert their surplus capital into cash-generating assets. In many cases, a massive salary acts as an active financial impediment. It forces the earner into a high-cost social ecosystem designed to continually drain their surplus. Even those who successfully accumulate a large portfolio face another trap: the professional wealth management industry. The standard model for a financial advisor is based on assets under management. You hand over your portfolio, and the advisor extracts a continuous percentage fee, often 1% or more, every single year, based on the total wealth they hold for you. Suppose you hold a $500,000 mortgage at 5% interest, and you ask your advisor if you should withdraw funds to pay it off entirely. The mathematically correct advice might be to eliminate that debt, but withdrawing $500,000 reduces the total assets under management, which directly slashes their personal income. Even well-meaning professionals have personal bills and lifestyle pressures. Providing fiduciary guidance that shrinks their own slice of the pie creates a severe conflict of interest. Delegating your financial agency to a middleman inherently aligns your portfolio's utility with their commission structure, instead of prioritizing your absolute financial freedom. At the absolute apex of the wealth ladder, the extraction mechanisms become systemic and legally binding. Nowhere is this more devastating than in the framework of a high-net-worth divorce. Consider a titan worth $500 million, trapped in legal proceedings that have dragged on for over 6 years. Because this individual is the primary breadwinner, the court mandates that they cover the legal costs for their spouse. The opposing law firm is being paid by the very person they are fighting, creating a massive financial incentive to endlessly prolong the litigation. To maximize the eventual payout, the opposing legal team weaponizes the subjective value of the individual's businesses. An illiquid company, objectively worth $100 million, will be aggressively argued to be worth $500 million in front of a judge. To meet these fabricated obligations, the individual is forced to liquidate prime foundational investments, taking catastrophic tax hits to feed an extortionate legal machine. At the highest levels, the legal system takes your most valuable, hard-earned assets and transforms them into the exact ammunition used to dismantle you. If the banking system extracts your wealth at the bottom, the advisory matrix drains it in the middle, and the legal framework targets it at the top, how do you build an uncompromised portfolio? The structural alternative relies on broad-based, low-cost stock index funds, a concept pioneered by investor John Bogle that entirely bypasses the need for institutional middlemen. An index fund automatically buys a tiny slice of every publicly traded company. It is a self-cleansing mechanism. When an old corporation fails, it naturally drops out, and capital automatically flows into rising innovators that replace it. Look at the mid-century dominance of retail monopolies like Sears. They built the tallest building and seemed financially untouchable, until leaner competitors eroded their share. If you held a broad index fund, you didn't need to predict the collapse of Sears. The fund automatically absorbed the technology monopolies that took its place, capturing the growth without generating a single management fee. You do not need to play a rigged game. If the system is designed to consume you, what is your escape plan? Subscribe to the CEO Brief and comment your raw truth below.